Yeah, cash on cash is basically measuring how much total capital it takes to put into the property, as like meaning your improvements that you're going to put in and all of that, and then it's divided by the total purchase price, and that's just the ratio that you get from that and what your return is going to be. And so that's one of that we look for. And then another that we look for is the cap rate, which again is just the total purchase price divided by, no, wait, sorry, is the total purchase price divided by the market value. And then we also look for,
Oh, go ahead. Sorry.
sorry, and then the debt coverage ratio. And so we typically look for above 1.6, and for our cash on cash we're looking for like a 8 to 9, and then our cap rate is around a 6%. And again, like we buy in location, so our target market is in Tucson, Arizona, and we're looking for areas that are B as well as buildings that are type B, and properties with the vintage of 1990 to 200 2000, sorry. And we like stable assets because we don't want to take on too much risk, but we want to get in there and we want to raise rents, raise occupancy, and just stabilize the asset in order to provide for our investors and their returns. And that's typically what we're looking for. There's a whole lot of other mathematical equations, but we use a calculator that's like 10 pages long. And so it's really in depth when we go over all of them, and only a few of them make it to that stage because if you did that for everyone, it'd be no point. But we just really look at those three at first. Did you have anything to add?
Sure. Probably one of the first things I would do is find out what is your goal versus what am I looking for, and what it was, whether that's for this particular property, because each property that you plan to add to your portfolio should have its own unique purpose, and it should fit into your whole plan. And if you aren't thinking holistically, that's okay. It's a starting conversation, right? You might just be thinking about your first property, and that's completely okay. But you start getting into a term called buy box, and that's what Kaya just kind of outlaid right there. And that can be very different for each person. And you're going to want to have that defined so that as you're going through the calculations, you're looking for specific. She mentioned vintage and like the year, class B. There's A, B, C, D, meaning all those different types. A meaning it's ready to go. You won't have much renovations. Newer, all the way down to where you might have a B, where you have some opportunity to improve, but you don't need to do much in order to increase those rents, maintain vacancy. And so it really depends. You might have somebody who really is in construction, and they might want to have a complete fixer of 40, 80 doors. That's a bigger chore, but you might have the capacity to pull that off, which you can come in at a lower price, make bigger improvements, so then when you go to refinance or sell it, you have more of a profit there.